Thank you for joining us. We have a great show today. Today we're going to talk specifically about variable rate mortgages with a fixed payment and those that have triggers. We're receiving a lot of phone calls. Let me start by introducing my wonderful team of mortgage agents. I'm super happy to have them here with me because these guys are knowledgeable. They're the best in the industry, and they're going to be able to answer some of our typical questions that we have here. So we've got Tyler Hibbs out in Niagara. Tyler.
What's going on, guys?
We've got Amanda.
Hello.
Amanda, how's it going, Amanda?
Good. How are you?
Very good. And we've got Stephen Arcuri out in Niagara as well. How's it going?
Everything's good today, Vince. Thanks for having me on.
Beauty. Okay, so here we are. So what we're going to do, guys, is we're going to just talk about, again, the trigger rates that apply to variable rate mortgages. And again, we'll start really with the basics here. Tyler, maybe you can tell us how does one know? So how does a client know if they're in a variable rate with a fixed payment, or if there's a trigger that applies to their variable rate mortgage? I know it sounds really basic, but I know you guys are all getting these types of questions, right?
Absolutely. It's even, you're sitting down with friends, family, whatever the case may be, and you're having the discussion on rate, and it often comes up. It's like, hey, listen, I was advised by my previous broker or branch employee that I'm in a variable rate mortgage, but my payment hasn't changed, right? So I think a good way to start is just like define what the difference is between the two. And obviously a standard variable versus adjustable, or a variable with a fixed payment. And really, with a variable rate mortgage, you're going to see that like every single payment, that a differentiator between obviously your payments will change if interest changes, right? So you're going to see your payments on a monthly basis or whatever your frequency changes versus an adjustable or a fixed rate variable rate payment, where you're going to see your amortization change. Right. So basically, as long as there's a portion of your mortgage payment that is going towards the principal and the interest, you haven't yet hit that trigger point. As a definition, it's basically where you're no longer making that payment where it covers just your interest. You've hit that trigger point. What you're going to see is, you're going to be called in, and you're going to have to do a lump sum where payments will change. So by definition, that really is the difference between the two of them.
So safe to say, like we could compare this really to what the investment industry calls like a margin call, right? Where they would call a client and say, hey, we need you to put money into your investment account. We're now telling you clients would be getting a call. And this is kind of first time ever, I really think, where clients are going to be getting phone calls, or clients are already receiving phone calls, mostly by surprise, saying, you're in a variable rate. Funny, yeah, I realize I'm in a variable rate, but my payment never changed. There are clients that are, that have thought that, of course. But now, as Tyler mentioned, we're getting to a point where these payments are going to be comprised or some of them are getting comprised all of interest. So there's no principal repayment occurring, which means that in order to stay in line with your amortization, we now need to, pony up and either increase the payment or do a lump sum payment on principal. And I don't know, Amanda, how are you finding, how are clients reacting to this? There's a lot of fear out there. I mean, even in the media, right? We're starting to hear this. I don't know, trigger rate is a new word. It's not new in the industry, but it's definitely new in a client's vocabulary.
Big part of it is the first piece of education. What does trigger rate mean? How does it affect me? Oh yeah, I've noticed my payments have never changed. You're right. Clients don't really pay attention to that and associate it with their term or variable versus an adjustable. So it's becoming more of an education piece for us, which is what we've always positioned ourselves on the Meta team for, is making sure that our clients are educated. So a big part of that, now that we are in this new industry, in a sense, where we haven't hit a trigger rate in the past, or a lot of our clients haven't had to hit a trigger rate, is educating them on what can you do proactively before you get to that point where you get a letter from your lender, or you get to that point where now you're stuck in this new trigger rate and new payment. What can you do beforehand? And a lot of that comes down to knowing what options you have through the particular lender we've chosen for you, your broker or your branch. What options do you have to prepay? A lot of lenders will allow you to double up your mortgage payments. You can increase your payment. or do a lump sum. All those options go straight to your principal, which ultimately helps reduce your overall amortization. So to Tyler's point, when you hit a trigger point, your amortization is increasing, recognizing that those payments are not being captured anymore. So proactively, we can help our clients and help those in the industry who have this type of mortgage to put an extra payment on your principal, take some savings, put a lump sum on the mortgage to help reduce the overall amortization, put more towards your principal, benefit yourself rather than paying to the lender, and set yourself up for success rather than waiting for that letter to come through in the mail, rather than waiting for maybe my mortgage will hit the trigger, maybe it won't. There's a number of different lenders that don't really disclose what their trigger rate is. So it is up in the air. So just to proactively let our clients know and those in the industry that may have this mortgage, look into it before, rates do potentially change again, and give yourself that opportunity to pay down a little bit more beforehand.
Yeah, that's great advice. Like at the end of the day, if you don't know what product you're in, because fact of the matter is not every variable rate mortgage, just to be very clear, not every variable rate mortgage has a trigger rate, right? In fact, most don't have a trigger rate. And so they're true variables where the payment changes every time there's an adjustment to the rate. Whereas this trigger rate applies to fixed payment, variable rate mortgages, which essentially can definitely sneak up on you, by surprise. So I love that advice, Amanda. Now, Stephen,
Yes.
I know you have a diagram for us, which is really good. I'd like you to, I've got the share screen enabled. We're all visual learners. In fact, all of us, when we pre-qualify our clients, we use some visuals. So what better time than to add more visual to this? Okay, so Stephen, walk us through this.
Yeah, so I'll just kind of take us through here with the definition or how a trigger rate is actually calculated, right? And Tyler did a good job explaining of when that point happens. So how that's actually calculated is pretty simple, and it's in this example here. So you take the payment amount, multiply it by the number of payments per year, and then you divide that by the balance owing, and that shows you essentially at what time will your payment just cover the interest costs of that mortgage, and that is essentially the trigger rate. Okay.
Hold on, Stephen, just to be clear here. So you're talking about scenario one. If you could use your mouse here, then you can actually help us.
Yeah, for sure.
There you go. Yeah, that'll help us. Yeah. Just so we can follow on the screen. Go ahead.
Awesome. Yeah. So that was just the trigger rate there. And then it essentially gives you the rate in a percentage term. So for scenario one, I broke it down into two scenarios, and this is kind of, very illustrative of what we've seen in the last 6 months or so in terms of rates and where rates potentially will be going in the next couple of weeks here with the pending increase by the Bank of Canada again. So I'll kind of break it down here. So original principal balance we've used for argument's sake of 600,000 as of January of this past January. The original rate at that time, I've used prime -1, which at that particular point in time would have been 1.7%. The amortization period of 30 years, the payment amount biweekly, given that information above of $1,063.52. And as of today's date, approximately the current balance owing will be $591.80. So plugging those figures into this formula here, that gives us a trigger rate of 4.67%. Okay, so that is the rate at which, if the rates increase higher, anything above that, if their variable rate exceeds that, the payment amount will be reset as per their original contractual amortization period, given the current rate environment. So what does that look like moving forward? So I'm just going to scoot over to scenario 2 here, just to show you that it is important to note that as you decrease your amortization period, so the shorter amortization periods of mortgages, let's say they took a 25 or a 20 year, the less likely that client is going to be to hit a trigger rate, and therefore they're less likely they will to have their payments increased. And that's just based on the science behind a blended payment amortization schedule, in that, the shorter the amortization period, the more of your payment goes towards principal right off the hop, as opposed to a 30-year mortgage, right? So in this case here, just for argument's sake, the trigger rate you can see is substantially higher by, 80 basis points or so. So what happens in scenario 1? And this scenario 1 is indicative of a lot of clients that I've seen over the last 6 months, especially with the housing market exploding over the last 18 months, given COVID. more and more clients are taking a 30-year. And if you're in a 30-year fixed payment VRM, this may be similar to your situation. So what happens if the Bank of Canada increases rates by another % in September, which all signs are pointing to somewhere in that range? What does that do? So this client's payment now becomes prime -1. So 5.7 minus 1 is 4.7%. Pretty simple math there. What does that do? So now their new payments are set based on that 4.7%, based on a 30-year AM to keep them on their contractual original amortization period. The new payment amount becomes $1521.93 biweekly. The increase in payments become approximately $458.41 biweekly, and that amounts to a 43% increase in the client's biweekly payments. So you can see from this diagram here that a trigger point for some clients will be a shock to the system. And to Amanda's point, there are ways that we can mitigate this, and there are ways that we can coach our clients into avoiding this type of situation. But back to Amanda and to Tyler's point, it is important that we are having these conversations with clients, or for clients to reach out to us to make sure that, you know, they're in a situation where they feel most comfortable in. And if it comes to a point where that trigger point is reached and they're unaware of it, as you can imagine, a 43% increase in your payments on a biweekly basis, you know, may wreak havoc on someone's budget.
Yeah, because they've been used to paying $1,063 because they were essentially in a fixed payment this whole time. Now the rate's gone up to 4.7, which is just higher, just above their trigger rate of 467. And so now all in one shot, they're getting hit with the payment increase rather than a gradual increase in a variable rate, like the traditional variable rate with a variable payment. That's what we're saying, right?
That's exactly it in a nutshell. You got it.
Wow.
I'm going to bet to say not a lot of people really understand that. It's taken us a little bit of time to really understand this, being that we haven't had to experience this in the past. So
For sure.
I'm going to guess a lot of our clients, a lot of people out there don't understand truly what a trigger rate is or how much it can actually affect them. So good to not only show them the scenarios, but really to reach out to your broker, reach out to whoever you got your mortgage through, and have that conversation, re-educate yourself, because it's something that's very new for a lot in the industry.
For sure.
And now that you're saying that, I would say, Tyler, I'm going to loop you in here because we chatted about this a little earlier. Is you've spoken to a few people who are in the industry and specifically working in banks, and they're not necessarily up to speed on this information. This kind of ties in with what Amanda just said as well. So Tyler, tell us about that.
Yeah, I mean, just like, I'm glad Steven put this together, because really every scenario is going to be different. So if you have questions, like, do the math, reach out to people that are obviously going to be willing to help you out. As long as it's someone that, is trusted, that can do the math and be able to figure out what the trigger payment is. But kind of with our discussion earlier, really, it's just a lot of events, like the branch employees aren't really sure. Like to Amanda's point, like, we haven't really seen this, or even, you have someone that's worked in the industry for even like 8 to 10 years with the same institution that knows the products and services, because they just work with the one institution and they don't know exactly what this payment is or how it impacts their clients, right? So having a roundtable with people that are going to be well versed and educated in this, they're the ones that you're going to look to determine, like, if this really does happen to me, like to Amanda's point, what can I do to avoid it? And what, to Steven's point, exactly, if it does come, what does that actually mean for me on a bi-weekly or monthly payment, right? So it's not just, these are great conversations to have, just because there's a big lack of education on trigger points and just product knowledge in general, right? So even if your branch employees, it may not be the ones to go to the professionals on it, because it's something they haven't seen before. So we got to give them that. But it's something that's, if Steven's point, when we do see an increase in September, there's going to be a lot of people that fall in this bucket.
Yeah, so uncharted territory is what I'm gathering from what you guys are saying.
Yeah.
And also, I don't think, not to scare anyone, but I think that we're telling clients is not to be surprised if your banker or mortgage professional doesn't know how to react with this trigger, or explain the trigger point and how it works and what it's going to do and the impact it's going to have, because again, it's uncharted territory, right? So
and maybe the worst thing to assume is looking at those scenarios that Stephen had and assuming, okay, well, I'll just lock into a fixed term, a fixed rate, a fixed term, then I'll be good. Going back to the way that Stephen, myself, you, Vince, manage our clients, a lot of it is suitability, a lot of it is budget. Yes, those rates are going up, but there's a reason why this was set for you maybe a year ago, 2-3 years ago. So reviewing maybe where those goals are, where that suitability is, what does a budget look like, rather than just jumping to, okay, well, here's the rates, this is the way it is, I'm stuck in a fixed payment anyway, so I'll just lock in that interest rate as well.
For sure. That's
and again, to that point, Amanda, I have a feeling we are going to be, being contacted by some of our clients come September, and there might be a little misunderstanding there in regards to what that means to actually lock into that rate that they're now going to be essentially basing their payments off of. The rate that they will be locking into at that point in time will not be whatever that trigger rate or that rate that the new payments are based on. So it's important for us to also inform the client that that's great. Maybe if you're looking at locking in at this point in time, your rate now will be more than likely 1% higher than what the variable rate that your new payments are based on, as per that last scenario I went through, right? So again, it comes back down to suitability and just providing our clients with the knowledge to make the educated choice at that point.
Absolutely, and I can vouch for each one of you guys. I know that you guys do a great job with suitability with every one of your clients. So I know that they're all in great hands. So it's for sure important to come back to that and go, okay, well, what are the true goals of the client at the end of the day, and sort of revisit what the suitability was at the time when they took the mortgage, and then are they still applicable today, and are there new goals, right? Because things do change with everyone. So I think we've hit it, guys. What do you guys think? Are there any other items, any other things that you want to talk about on this specific topic?
I think the only thing that we were talking about earlier that we still have really to get set answers on, and correct me if I'm wrong, but for a lot of clients that are in these variable adjustable mortgages, a big part of having variable is to benefit from fluctuating rates. But if you do hit that trigger rate and you're still in that variable term, doesn't necessarily mean that your payment is going to reduce when rates go back down.
Good point.
Right.
Something to note as well. Once you hit that, you're still staying there. You don't necessarily have the benefit of those fluctuations in the market.
Right. No, exactly. So you're in that product unless we switch you out of it, and that might mean that you either get into a variable rate with a variable payment, which may be something that may be now more suitable given that the times have changed, obviously, right? Or as Stephen mentioned, going into the fixed, but not only accepting a new higher payment, but an even higher payment now because fixed rates are even higher than those available in the variable rate market. So yeah, all really important points. Thank you, Amanda, for that one. Anyone else? Tyler, any parting words?
No, I think just overall, just if you have any questions in general, Stephen's point and Amanda's, I'm glad you talked about the fixed rate. It's just suitability is so important in a role. And when we get calls to what's your rate, it's so much deeper than that. And it doesn't have to be anyone even on the screen here, but if you have someone that you can reach out to that will give you honest and educate you on options, to me that's the most important thing, really.
Sorry guys, we got cut off here, so Cass will have to do some editing. So let me ask that question again, okay? So you get a round two on that one. So okay, great, thank you so much, Amanda. Any parting words from you, Tyler?
Yeah, I think just it's important to be educated on your options. So Amanda and Steve both talked about flipping over to a fix. There's obviously implications to that. So aligning what your goals is with the property is very important. Just being asked, what's your rate to a mortgage broker? There's such a deeper conversation to that. The last thing you want to do is, oh, here's your cheapest rate, but there's maybe there's some implications of going down that route. in the foreseeable future, or even a long-term future. So just having a round table with someone that you trust, it doesn't have to be even anyone on the screen. That's going to educate you on options and the pros and cons of those options, essentially. This is what I can push.
Absolutely. Love it. Music to our ears. All of us are shaking. Yes. Stephen, how about yourself? Any parting words? Thanks so much for putting that diagram together. Getting into the nitty gritty. It's never easy, but any parting words?
No, I guess just echoing what Tyler and Amanda have said around suitability, right? I mean, the education piece for me is always number one with my clients, just ensuring that they understand what type of product they're getting into and the implications, like Tyler had said, about certain aspects of those types of products. And now this environment is really bringing some things to light that in the past light had not been shed on, in particular, the fixed payment VRMs and these trigger rates, trigger points. So I can't stress enough, work with your mortgage professional, work with someone you trust, and have them look after your needs.
Absolutely. All the more reason when there's a little disruption in the market, you really get to see sort of what our relationships or your relationships are made of, right? In this case, are they made purely based on a surface transaction, or are they made on a deep-rooted relationship? And I know that all of you have created that with your clients. Amanda, any last words for you?
I think pretty much everything's been said. Keep in touch with your clients. Sometimes it requires us to reach out to them if we know they're in this type of product, not necessarily for them to wait for them to reach out to us. So I plan to do that with a few clients, just make sure that they understand what might be coming end of September, and just keep the communication lines open. A lot of people think with brokers we take care of them to finance and then we're gone. And in the case of our team, we're always there, willing to help throughout the years that they're in their mortgage term. So just making sure that they understand we're a sounding board and we're here to give them advice.
Awesome. Thanks, guys. Listen, I truly privileged to have you guys part of the team. You guys are top notch, and your knowledge is very deep. We do definitely get together on a weekly basis to brainstorm as well, for the benefit of all our clients. So anyone out there has any questions and wants to reach out, you know where to find us, and you can get a hold of anyone here on the screen. Also keep an eye on social media and on our YouTube channel, our newly created YouTube channel. Thanks to Cass, who's put that together. She's doing a great job. And we're going to keep adding more information out there. There is a lack of financial literacy. All of you guys on the screen are great advocates for financial literacy, and clients are thirsty for it. So thanks again so much for being on. We'll have you again very, very soon. Thank you.
Thanks for having us.
Thanks, Vince.